When you talk about a balance sheet of a country, I think it's important to understand that there is no balancing element.
Markets like predictability, and so therefore the operative word there is predictable. But if you will always have companies, and we've seen many of these companies over the last 25 years, they've had fantastic growth. They've come in and increased the amount of borrowings or leverage on balance sheet. There's been a downturn, they've got wiped out.
There is this notion of this, performance and health, right? Like how you're doing today is your performance, and health is how you will do maybe 18 months down the line or 24 months down the line. Hello, and welcome to another episode of Open Dialogue by Axis Bank. Open Dialogue is a forum that brings together leading experts to talk about topics of macroeconomics, finance and banking. I am Sameer Shetty and I'm your host for these sessions. Today we have two stalwarts joining us for the conversation. We have Rajiv Anand and we have Neelkanth Mishra. Rajiv is the Deputy Managing Director at Axis Bank. He has spent multiple years in key management positions in global institutions across areas of asset management, treasury, retail banking and wholesale banking. We also have Neelkanth Mishra. Neelkanth is the Chief Economist at Axis Bank. He is also a member of the Prime Minister's Economic Advisory Council, and very recently he's been appointed the Chairman of the UIDAI. Neelkanth is a very popular face in the area of macroeconomics, and he will join us today to share his views as well. Over the next few episodes, we will deep dive into India and talk about various macro and micro topics that concern the evolution of the Indian economy. We will talk about GDP growth, balance sheet, some micro trends, and also deep dive into topical areas that are of interest for the country. Today, we will focus primarily on the balance sheet of the country and how that is evolving and how that affects the future. So let's start. Neelkanth, if we can start with you. Maybe you can just help us understand what exactly is a balance sheet, and particularly when we talk of a country, how do you think of a balance sheet?
It's a great question. A balance sheet is a snapshot. So GDP is like income. So there's a flow. So there's a flow measure. A balance sheet for a company, the reason it's called balanced is that there are assets on one side, liabilities on the other. We'll discuss how we differentiate between a good quality company and a bad quality company on the basis of that. When you talk about a balance sheet of a country, I think it's important to understand that there is no balancing element, right? There is, but it's more of a snapshot. There are two ways to...
Sorry, I'll just interject you there. You said that there is no balancing element. So what does that mean? Can you maybe elaborate a little bit?
Yeah. So for a country, the assets and the liabilities do not necessarily need to match. So for example, if you look at India's international investment position, so the country as a whole owns about $900 billion of foreign assets.
Right.
So this could be the RBI holding US treasuries, it could be individuals owning foreign equities, it could be companies owning foreign subsidiaries. And India also has about $1.27 trillion of international liabilities. Basically, Indian companies having foreign loans. So this doesn't need to match. At a global level, the assets and liabilities obviously have to match. But for a country, when you're looking at the balance sheet in the form of international investment position, they don't need to match.
So this you're talking only of the international or overall balance sheet also?
I'll come to a second measure of the Indian country's balance sheet, which is what we call debt to GDP.
Right.
So once a country starts spending more than it has, in the sense that if you're collecting 100 rupees of taxes, but your government is spending 120, 130, 150 rupees, you are effectively borrowing from the future. So you are imposing this burden on future taxpayers. And so sovereign debt to GDP, which is if you aggregate the central government debt, the state government debt, the municipal government debt, and you look at it as a percentage of what your annual income is, which is GDP, this ratio is the sovereign debt to GDP. And this is also a measure of how healthy the government's or the country's position is, in the sense that if it is low, you have not borrowed from the future. If it is very high, then you have been borrowing from the future, and then you need to slow down.
Right. Understood. Great. Thanks, Neelkanth. Rajiv, moving on to you. So Neelkanth spoke about what the country's balance sheet is, but how do you think of a good balance sheet versus a bad balance sheet? And is there a quote unquote good balance sheet, or like anything is fine?
I think, and there are multiple, he spoke about the country's balance sheet. There are multiple balance sheets now. There is a corporate balance sheet and there is a household balance sheet as well. And let's start to focus first on the corporate balance sheet. Obviously, companies that are growing, are profitable, and have low leverage. Leverage meaning amount of borrowings that you have on balance sheet are typically considered to be good. And from an equity perspective, I mean, why equity? Even from a fixed income perspective, companies that are able to deliver sustainable, predictable, long-term earnings are considered to be good. Markets like predictability, and so therefore, the operative word there is predictable. But if you will always have companies, and we've seen many of these companies over the last 25 years, they've had fantastic growth. They've come in and increased the amount of borrowings or leverage on balance sheet. There's been a downturn, they've got wiped out. What happens? Any corporate has a certain amount of capital, which is the amount of money that the promoter has brought in. With that amount of money, you can only grow to a certain extent, right? I mean, you can only buy that much. Suppose you have 100 rupees, you can only buy 100 rupees of assets, and assuming that the asset turn is one time, you can have only 100 rupees worth of income, and let's say you make 20% profits on that, it is 20 rupees. But if you want to increase, I mean, and a great example of a leveraged business is banks or non-finance companies. We have a certain amount of capital, we lever that up either through deposits or borrowings, and then we create a balance sheet on by either loans to the corporate side or the retail side. So yes, there are good balance sheets and bad balance sheets. What you want to see as a lender, and given that we are among the largest lenders in the marketplace, what we want to see is first and foremost a good quality management who has a long-term track record. You want to be in an industry which is growing. You want to be in a sense the market leader, or somebody who has a moat around them, which means that they have some competitive skill that is differentiating them in the marketplace. They are gaining market share, and therefore they have better earnings or better earnings than their peers, and they have built their balance sheet on the back of relatively small leverage.
Right.
You do need leverage, either long-term leverage. If you're looking to set up plant and machinery, it will take you. I mean, you put up a plant today. By the time it finally starts to roll rupees out of it, it may take 2 to 3 years. So you need a term loan to be able to fund that, and therefore you want to be with companies that are able to commission these plants with a certain level of predictability to be able to repay you back, or you could have instances where working capital cycles, which is basically when you need to buy raw material, and when you sell, you can sort of you make a little profit, but in between you have cash flow mismatches, which is what is called working capital. So bank corporates could also borrow working capital requirements from banks. So there are two types of borrowings that they would take, either working capital, which is short term, or long term term loans, which is typically as you think about raising the size of your companies, etc. So if I were to look at a good balance sheet and P&L, and I think both go together, is like I said, it is a business which is growing with predictable margins, predictable cash flows with relatively lower leverage. What we saw, unfortunately in the country, let's say between 2012-13 to 2017-18, was that corporate balance sheets in India got over levered, right? And then we saw the downturn, post that for various reasons. I mean, some political, some regulatory, and so on and so forth. And as a result of that, banks saw significant amount of NPAs built on their portfolios, which is when we came across what was at that point in time called a twin balance sheet problem in India, which means banks were unable to lend even further because there's a lot of NPA sitting on their portfolio and they needed to clean that up, and at the same time corporates were unable to grow because they had over levered themselves and in a sense burnt out because of the problems that we saw in the country at that point in time. Today the situation is exactly the opposite.
Sure.
Right? Bank balance sheets are in pristine shape, they are well capitalized, well provided for, margins are good, growth is good, and the credit cycle is relatively benign, and which means that the banking sector in India is well positioned to be able to support growth for this country. On the other hand, you are seeing corporate balance sheets are probably in the best that they have been in a decade. Debt to EBITDA is like 1.5, 1.6 times, which is a very low number. Debt equity is less than 1, which is again a very, very healthy number, which means that corporates, as and when promoters in India begin to see that that the future is good and that demand is good, they will start to invest and grow, and the headroom for growth because of the relatively low leverage that is there at this point in time certainly exists. So you've got this virtuous cycle now that banks are in a great shape, they want to lend, and corporates are in a great shape, and hopefully they will start to grow, and therefore banks being confident to be able to lend to these balance sheets, hopefully we'll get into that virtuous cycle of growth as we go forward.
Thanks, Rajiv. I'll come back to this kind of prospects of corporate lending in a bit, but Neelkanth, back to you. Rajiv spoke a lot about corporate balance sheets. If you can just talk us through what has happened to the nation's balance sheet over the last decade, and are there some fundamental shifts, and where are we today, and what that does mean for the, let's say, the next 10 years.
Just to add to what Rajiv said as well, that the concept of a balance sheet is a snapshot. So if you are, say, in a race, how much power do you have left in you? Like it's like those batteries, which can keep running. So are you early in the race or are you late in the race? So if you have a heavily leveraged balance sheet, so the scenario that Rajiv explained existed between 2012 and 18 was where it was what you call a late cycle play, so that you are maxed out on your growth, and therefore you had to slow down, digest all the excess debt. Now you are now ready to start growing again.
So there is this notion of this, we used to hear a lot of performance and health, right? Like performance is maybe your P&L, and health is like how you are doing today is your performance, and health is how you will do maybe 18 months down the line or 24 months down the line.
How long can you keep performing like that, and is your forward performance going to be better or not? And so the counter to that is China, right? So China is now excessively levered. They now need to deleverage. So that is what you would call a late cycle play, that their business cycle is now kind of peaked out, the debt cycle is peaked out. For the country, if you view it on both these measures that we discussed, the net international investment position and the sovereign debt to GDP, which are both important cyclical indicators, the net international investment position is currently at about minus 10% of GDP. So India is a net debtor country, as I said, $1.27 trillion of liabilities, $900 billion of assets. But on several measures, that indebtedness is not risky. See, just like early in the life of a person, it is okay to take some debt and say build a house, improve your quality. Just like that, for a country which is trying to grow faster, you are going to be dependent on external capital. So as foreign investors bring in equity, Indian companies go out and seek foreign debt, it helps you grow faster. So having a marginal negative position is actually not a problem. In fact, it is a desired outcome. This is how Indian policy is designed. The quality of the balance sheet is also very healthy, in the sense that most of our assets, foreign assets, are actually very liquid. So almost 65% of our foreign assets are held by the Reserve Bank of India. So if the currency comes under pressure, they can quickly be deployed. These are also very liquid assets, so they can very quickly. So in fact, one of the things that Rajiv was also mentioning, that when you're looking at the balance sheet, how liquid is it? I mean, if you need to get some cash very quickly, can you get that? So in 2013, our situation was much worse. So we had, and that is why we had the taper tantrum and the sharp depreciation in the currency. After that, our balance sheet has actually cleaned out. And in fact, the last couple of years, we've actually accumulated a lot of very healthy reserves. On the sovereign debt to GDP, and the situation is slightly less healthy. Our target is to be at 60% of GDP. We are at about 83% of GDP. The way to solve this problem, though, for a country which is relatively young, is to grow out of it. So debt to GDP, as you can imagine, is debt is in the numerator and GDP is in the denominator. If you try to reduce the debt to GDP by reducing your fiscal deficit, basically the government starts to tax a lot more or spends a lot less, GDP growth slows down. So remember that both these things are growing every year, and therefore the best way to do it is to reduce this ratio back to the sub 70 or maybe ideally 60% of GDP, is to grow nominal GDP much faster. And to do that, you need to invest productively, you need to do a lot of reforms. And if you assume 11% kind of nominal GDP growth over the next 10 years, then I think by 2031-32, we should be falling below 70s.
Right. So, Neelkanth, you mentioned a number of things which I think helpful to just deep dive on. First is this notion of the quality of the deficit. And if I can loosely translate it, and will be helpful to get your perspective, is that if you are borrowing and then you are using that to build something that gives you more income than the interest you pay out, then it is maybe a good borrowing. Whereas you're borrowing to go get drunk or whatever else, then it's not great borrowing. Right? So helpful to just kind of put this in the context of a nation, and also has India as a country progressed on this, or like what does our quality of spends or quality of assets, etc. look like?
Right. So progress on this is this is something, it's like maintaining good health. You have to be always on the watch.
Right.
The people who are in power, the reason why many political leaders, and you can see that in some of the state governments today, they get into power is to exercise power, right? And so then you have access to all the taxpayer money. And it is very tempting to spend other people's money. That, I will give free power, 100 units of free power to everyone. I will make bus rides free. I will switch all the government employees into the old pension scheme, which is defined benefits pension scheme. And it is very tempting to do that. And so this is a continuing battle. And we need to stay disciplined for 10 years to achieve the reduction in the debt to GDP ratio. So you're absolutely right that if you're getting 100 rupees of tax dollars, how you spend it actually does have an impact on how the debt to GDP moves. So if you just spend it on giving free power to people, it does not have long-lasting impact. It's as bad as drinking it away. If, however, if you spend it on, say, building a road, connecting, say, Delhi and Mumbai with an expressway where the time taken falls from 23 hours to, say, 12 hours, it can improve the economic productivity and therefore the growth of the economy for many, many years to come. So that's how it is. You can keep spending, because if you cut down spending, the GDP growth slows and that ratio starts to worsen. But if you keep spending, but you spend productively, it is possible over a period of time to do this. The reason why this 73-74% became actually 89% a couple of years back was primarily that nearly 50-60% of the income losses during the COVID lockdowns were borne by the government. And so we, as an economy, collectively decided to put it on our future selves or our kids, that the future taxpayers will bear the loss, because if you had allowed those losses to go through the economy, it would have been much more damaging. So now that this debt to GDP has gone up, we need to bring it down, and I think the prudent way to do that is by spending it on infrastructure, on what you call the high multiplier sectors. It is, where are we now? So at least the choices by the central government have actually been very prudent. So they have, as They had indicated 2-3 years back they're bringing down the fiscal deficit. The quality of expenditure has gone up, though it would be unwise to believe that this is how things will progress over the next 10 years, because you can always get governments with very different political objectives, and you're seeing that in some of the states where there's a lot of fiscal insecurity.
Right. Thanks, Neelkanth. I'll come back to you on one other point you mentioned subsequently, but let me move to Rajiv. And Rajiv, just help us understand from a kind of translating the macro to the micro, how does the balance sheet of the country impact behavior of corporates and retail consumers? Like what happens when countries are over leveraged or under leveraged or whatever?
Let's leave the leverage out for a moment. I think if the country can't do well in isolation. I think all the macroeconomic fundamentals that Neelkanth just spoke about is an outcome of the fact that whether it is the small banwala at one end of the spectrum or the super large corporates in this country are seeing increased demand for their goods and services. And because we are seeing increased demand for goods and services, people are expanding their production capacities. Most important, they're creating jobs. And because you're creating jobs, you have a multiplier impact as a result of that. The more jobs you create, first and foremost, especially in a country like ours, you're bringing more and more people from the informal to the formal sector. They then become, tax-paying entities. They become more lendable from a banking perspective. But fundamentally, the core of everything that we are doing is, in a sense, to be able to create livelihoods.
Right.
And if you are able to create that, there's one level before that, and we can come to that on whether these people are adequately trained to be able to create the right kind of jobs, because you want to create an economy which is value adding, right, rather than create an economy which is creating watchmen and delivery boys,
right,
which is not Neelkanth spoke about productivity. The GDP growth that we want to see, the quality of that growth is important as well, because just to the difference between creating a scientist and who is taking us to the moon versus a delivery boy, you can see the impact each of them is having on the economy, not just today but from a long term perspective as well. And so therefore, if the economy is doing well, it means that companies are doing well, small businesses are doing well, they are creating jobs, they are in turn, it has a multiplier impact. A Maruti, for example, if they are creating more cars, which means all the auto ancillaries are doing well. If the auto ancillaries are doing well, they are increasing capacities. If they are increasing capacities, you can see the percolation impact just by the fact that Maruti is selling one extra car, and that is what a good economy does. If and in a sense, you are able to better understand this when you think about it in the opposite direction, which is that if the economy is not doing well, you can see doom and gloom everywhere. Jobs are not getting created. There's social unrest everywhere, etc., etc. So therefore, creating a long-term sustainable economy is critical. It is not just the responsibility of the government, but of each one of us. Each one of us has a role to play in terms of what kind of skill sets you're bringing, what kind of productivity you're bringing, what kind of innovation you're bringing, what kind of skills you're bringing to be able to grow this economy.
Great, thanks Rajiv. So Neelkanth, coming to you, there were 3 things mentioned which I thought will be helpful to deep dive. First was this notion of a twin deficit. Second, you mentioned taper tantrum, and third, you mentioned that when you are you too much borrowings and stuff, your currency comes under attack, etc. Just help us understand what all of this means. Like, why would your currency come under attack if you're too much leverage, or why is there if in the US something happens, why should there be a taper tantrum in India, and why should the stock market fall?
Okay, so let's take a step back and think about what we call in economics spillover effects. Right? So the the US dollar is considered a safe currency, or and US dollar assets considered safe assets by everyone. And why that is so and how long that can remain so is a whole different debate. But the fact is that it's like, if you think a piece of like Cody that used to happen, right? Cody was a seashell effectively, but everyone thought it was worth some money. So if everyone thinks it's worth some money, it's worth some money, right? So it is what it is. Now, occasionally what happens is that if, say, as a country, and this is what we did in 2009-10, we effectively doubled government salaries. So they went out and spent. They bought a lot of cars, they bought a lot of houses, the economy did very well. But if you think about India's economy as a black box, if you're just printing money and giving it to people for free, for a while it feels very good, but what it starts to do is that it starts to create external imbalances. This is what is called the current account deficit.
Right.
So what is the current account deficit? That you are consuming more than you are producing.
Right.
Now think about it this way: in a black box, you are printing money and consuming, so your consumption is going up, but your production is not going up by the same quantity, and therefore your current account deficit widens. Now you need more dollars. Where do you find the dollars? So you start borrowing.
So why does the current account deficit widen when you do this?
So suppose the economy has $120 of consumption,
right,
and $100 of production.
Right.
There is a $20 current account deficit.
So you're importing it from somewhere basically.
Yes. Yeah. So because we import oil, we import
Yep.
gold, because a lot of these things we don't have. Now suppose you printed 20 rupees and distributed it among people, which is effectively what we did, right? So we
Yep.
increased our fiscal deficit and we distributed it among government employees. Then your consumption has now gone to 140.
Yep.
But your production is maybe
Still
110,
100, yeah.
right? Maybe because of that some additional car
Sure.
production happened or something, but net your current account deficit has now widened from 20 to 30.
Right.
Now you need the dollars to fund that. Okay, what we fund it with generally is by foreign portfolio investors buying Indian equity. So we are effectively selling our assets to foreigners so that we can consume more than we produce. After a certain time, what happens is that our external liabilities start going up. It's like, if you are in a household, and we all know of our extended families where people sell their land and consume till the time that they'll run out of land, right? And this is exactly what happened in 2013, that our external balance sheet had international investment position had worsened. We had accumulated a lot of what we call short-term debt to fund our consumption. And so when the US dollar interest rate expectations started going up, so all of this was happening because when the US dollar rates are very low and the US Fed was printing currency, everyone was finding higher yields. So in Indian bonds, you could get better returns in India. So you were sending a lot of money into India.
Right.
The moment the Federal Reserve in the US, the central bank in the US, said that we may start to raise rates now, then all the people who had sent money to India said, oh boy, now it's no longer as viable, so let me start pulling out.
And put money into the US treasury so that I get higher interest there.
Exactly. So at the margin, what that does is now suddenly you're not getting $30.
Right.
And because you had accumulated so much of very poor quality liabilities, you also get into deeper trouble. And then the economy has to go through a very sharp readjustment. So what happens is the currency then depreciates. So we
Right.
went from 54 to 67, 68 to the dollar. So imports became very expensive, exports became a lot cheaper, and so that adjustment had to be undertaken. And so that leads to a lot of pain. Short term, the economy slowed down very sharply. Interest rates had to be jacked up to slow down the economy. It creates a lot of problem. This is a classic example of when you spend beyond your means, you destroy your balance sheet. So if you were in 2012-13, when you saw the Indian economy, you said, wow, we're growing so fast. But if you had looked at the balance sheet, you would have said, oh my God, the corporate leverage is going up, bank leverage is going up, the international investment position is completely in a very bad place, and government debt to GDP was also very high. So on a balance sheet perspective, you would have said, my God, this growth cannot sustain. Today, you can say the reverse.
So, this is the interesting point that I was coming to, Neelkanth, which is in 2013, I think the Fed threatened to raise interest rates and all of this happened. In the last 18 months or so, the Fed has raised interest rates by 500 basis points. And our markets seem to be, defying all gravity. So, what changed so much?
Discipline. So if you are seen as a place with macroeconomic stability, where the governments the state and central governments are not seen as profligate, where they're seen as respecting future taxpayer and respecting their what their commitments are. Investors want to get into these places. The second, because people forget that a lot of the current account deficit, what is the external imbalance, is also a reflection of the internal imbalance, which is that if the governments are spending way beyond what the tax collections are, you are effectively printing money to consume.
Right.
So if you are seen as fiscally disciplined, your current account balance also becomes much more manageable. In 2013, our current account deficit had reached 4.5% or 4.8% of GDP. Today, it is less than 2% of GDP, and in 2 to 3 years' time, if the current trends persist, we could be current account surplus.
Yeah.
So our dependence on external dollars is not that high. Some of the pain that was borne by emerging market economies in 2013 has also resulted in corrective measures.
Right.
So policymakers are now aware that these risks can build up. So even in the UPA regime, the fiscal consolidation process had started. The desire for many of these economies to build significant reserves is also helped. Right? So if you have $600 billion of reserves, $10-20 billion of short-term outflows, the Reserve Bank can handle. So that makes you very stable, and because everyone sees you as stable, you actually don't get into trouble.
Right. So Raju, just moving on from that point, so we heard of all the entire setup and so on and so forth. And also, by the way, there has been a lot of productive investment into the economy around infrastructure and so on and so forth. At the same time, credit demand from corporates has been reasonably muted over the last few years. So how do you kind of square the two? What's happening here, and what do you see happening going forward?
So let me just, before I get to that, let me just add to some of the points that Neelkanth made to the question that you're asking. Markets are on a tear, and despite the fact that the Fed has raised rates by almost 500 basis points over the last 18 months or so. Look at how the Western world came out of COVID, and look at where we were at that point in time. The US, for example, once we in a sense got out of COVID, their interest rates were at 0, but their inflation was at close to 9%. Right, so the gap was dramatic, and therefore they had to throw the sledgehammer at the problem, and they continue to do so. We didn't have that problem.
Right.
I mean, even at the lowest during COVID, rates were between 3.5% to 4%. Inflation was somewhere between 6.5% to 7%, and then we very quickly raised rates by 200 basis points, and the gap narrowed. Right, and so therefore, to that extent, the inflation problem that the Western world saw, not just in the US but in Europe as well, because of the fact that the point that Neelkanth made is, I think we managed COVID quite spectacularly.
Right.
Programs like ECLGS were so well structured to be able to help the small businesses without impacting the fisc, as opposed to the structures that the US created, where the fiscal, i.e. the government, was putting dollars into people's accounts, and people were just going out and buying whatever they could online, or buying boats and cars and whatever else, and creating a long-term structural problem that you're seeing them grappling with today. So not just in terms of monetary policy, but fiscal policy also was I think very well managed, and I think we should give credit to the government.
The quality of spend was much better.
Much better managed, and it was much better controlled, much better focused, and I think most important, didn't put pressure on the future fisc.
Right.
And so therefore we're in a great situation today.
Right.
You've got the reserves, the current account deficit is in reasonably good shape. The whole monetary policy looks like it has managed inflation very well, and the fisc is, nobody is sort of throwing money at this point in time, and I think that's what ultimately is giving confidence to India Inc., and which is converting into profits, and ultimately therefore stock prices are going up. And I don't think there is a narrative that what we are seeing in the markets is irrational. I don't think so. You could argue on some pockets of overvaluation, etc., but those kind of pockets always remain. But if you look at it at an index level, valuations are reasonable, right? Because of the fact that markets have gone up, but so have revenues.
Right.
To the point that you spoke about, I think it's an interesting question, and I think one needs to break this up into multiple parts. What is happening in the large corporate space is, for whatever reason, and there are I think multiple reasons, the Indian promoter has become a lot more circumspect in terms of leverage.
Right.
Which means that yes, they want to grow their businesses, but they're not the kind of business growth that people were looking at in 12-13. We are not seeing that at this point in time. It is being, the size of the expansions are to a large degree being determined by the kind of cash flows that they're seeing in their businesses.
Right.
So let's say I need 1,000 crores over the next 5 years for me to double my capacity. They're saying, okay, let me double my capacity over the next 5 years. I can see that I will make about 200 to 250 crores every year to be able to support this. Maybe they will take 250, 300, 400 crores of leverage, but it's a very, very well controlled leverage. Therefore, to the point that you are making, that credit growth to the large corporates is relatively muted, is because of this.
Right.
Their own internal cash flows are strong, and they are very happy to use their internal cash flows and are eschewing leverage at this point in time. Will this continue over the next 2 to 3 years? One will have to wait and watch. So as you look at corporate India, maybe as an equity investor, this is a great situation to be in. Maybe as the head of a corporate bank, it's not a great situation to be. I certainly want to see them borrow more.
Yeah.
But I think what we are seeing is a lot more measured growth in corporate India, and I think in the long run that's good.
Right.
What we should be comfortable with is, given the state of the world economy, the fact that we are growing at, let's say, 6 to 6.5%. I think Neelkanth is also in that vicinity. Add another 5.5% of inflation, you're talking about 12% nominal. If we can grow the next decade at 12% nominal, I think we are in a fantastic place. You will see corporate profitability continue to grow. There will be predictability, and all the good things that Neelkanth spoke about in terms of the current account, the fisc, and monetary policy. I think is a great place to be.
Great, thanks Rajiv. So Neelkanth, one question, and then we'll move a little bit to consumers also. So the question I wanted to ask is that we've spoken a lot about kind of indebtedness, which is liability side, but also the other side of this equation, which also is controllable, is the quality of the asset itself and where the government spends. So there are productive assets, you mentioned infrastructure, healthcare, education, and so on and so forth. What's happening there? Are you seeing something happen there around the quality of that spend shifting, or some better type of assets coming out? Or earlier, the government used to own hotels and bakeries and so on and so forth. So do you see that shifting, or are we on some track there? Or?
No, absolutely. So the nature of the government's balance sheet is shifting. So if you see, the bakeries, etc., were sold off a while back, but there were you're right that there were, a modern bakery was owned by the government. But if you see government shareholding in the BSE 500, it has been steadily falling.
Right.
Some of it is because government-owned companies those stocks are not performing very well, but it's also because the government itself is trimming its holdings. So, and there is a very steady process of disinvestment. Even if that is not happening, because perhaps it's not happening as fast as even the government wanted, but at least more such assets are not being created.
Right.
Right. So as the economy keeps growing, the nature of the government's holdings as a percentage it keeps falling. Now, on the other hand, I think the government is starting to spend, like if you look at capex on railways now. In most economies, the rail share of freight is 60 to 70%. In India, it used to be that at the time of independence, but it has now fallen to 28%. So we need a significant amount of capex in railways. The government used to struggle to spend in that space, but we have now seen that from 1.5 lakh crores, 1.5 trillion rupees to first to 2, then 2.5, and now this year close to 3 trillion rupees are being spent on railways. So,
and that what is it being spent on? Because again, railways is another area where it's very easy to quote unquote dole out money, right? So, what's happening to the quality of that spend?
Yeah, so so this is being spent on electrification, doubling or tripling of tracks. So so there are freights like corridors where. And this is actually quite strange. When you look at the details, you wonder what they were thinking. But there are areas where, if you have a 100-kilometer stretch or a 500-kilometer stretch, and there is a 30-kilometer stretch where, so everything is two lane or two tracks, but there is one which is just one track. I mean,
and that's the bottleneck, right? So the rest of the two.
So you don't. It's not rocket science to figure out. But finally, those things are starting to get sorted out, right? So in the last 2 years, we've seen remarkable progress. So during COVID, because passenger trains were shut, the freight trains were moving at 3 times the speed, and people who observed these things, including me, expected that the moment the passenger trains came back, that freight speed will slow down and freight share will start falling again.
Right.
But it has not happened. So freight carried by railways continues to grow. So. Going forward with the dedicated freight corridors, the Western DFC, the Eastern DFC starting to get commissioned, I expect that. So yeah, so this type of balance sheet or good quality assets that the government is building up is definitely helping. There is also what I would call intangible balance sheet, meaning that government spending on education and health also is starting to rise, but you would expect that it should rise a lot faster. Because that's one area where we need to keep spending a lot more. State governments control both of these, so it's much more challenging to do it from Delhi. But what is encouraging, though I think there's a long way to go, is that the percentage of adults in the 18 to 25 range who are either graduates or are enrolled is now almost 4x what it was 20 years back. But still it's a small ratio, I mean a small percentage, and it needs to grow a lot.
Right. So Neelkanth, moving on
just to the point that Neelkanth was making, actually the beauty in India is if you look at infrastructure, I mean you just got to look out of the window and you realize how much of infrastructure spend we need. And you can continue to build out infrastructure for the next decade or maybe 2 decades, and demand will never be a problem. It's a very different situation to China, for example.
Absolutely.
I mean, where China you just keep building roads to nowhere and cities where there are no people living for the next decade. That's not the problem that we have here. And therefore, to that extent, infra should actually be a very good business to get into. But unfortunately, this thesis hasn't quite worked, which is why we now are in a situation where much of the infrastructure continues to get built out initially by the government, and then we are now seeing different structures in place. I mean, creating InvITs, REITs, etc., and then selling those assets down to the private sector. I mean, and it's very interesting that we are seeing a lot of money coming into Indian infrastructure from abroad. I mean, particularly the Canadians and long-term pension funds who want to buy into to Indian real estate, Indian infrastructure, etc. Because they can clearly see that, I mean, for them to be able to get maybe 7, 6, 7, 8% dollar returns for the next 25 years because of the fact that you just need to build a road and the demand will come is a story which is to my mind not available in very many countries at this point.
Yeah, and we seem to have reversed that as well, right? Like a decade back, you used to hear about this build, operate, transfer. Now it's almost the other way around. Like
Correct.
The government builds and then operates it for a bit and then transfers it to
correct, because of the fact that given the fact that we saw what we saw in the previous cycle, the confidence to do greenfield to that extent low, is very low, even from a banker perspective. Yeah. You may not necessarily want to get into some of these projects, but now the whole regulatory environment, for example, in roads through HAM and toll, etc., has significantly improved, and therefore the bankability of these projects has improved, and that is why we are seeing more global capital coming in on the back of that bank lending as well.
Great. So Rajiv and Neelkanth, it sounds like we are in a great position as a country. So in your minds, what are one or two risks that can come in the way of growth from here? Maybe Rajiv, we start with you.
I think there are two things that worry me. I think it's at the first level, it's really the kind of education that our people are receiving. I don't think we are paying enough attention to primary, secondary, etc., etc. I think the whole education process needs to be significantly strengthened as we go forward. And the second issue is, it is inevitable that climate change is going to hit us in some form or shape.
Right.
As a corporate banker, its implications on my clients and on our balance sheet is something that I think about all the time. We are already seeing changes in weather patterns. We've got floods at one point in time, and at the same time we've got drought in other parts of the country, and I think this unpredictability is only going to increase in the years to come. Its implications on the economy and therefore corporates and finally all of us is something that certainly worries me.
Sure. So hence the quality of spend on the asset side, which is the education that you spoke about, and climate, which is maybe a risk that is not captured in a balance sheet.
Correct.
Neelkanth?
So I would stretch it to, in addition to what Rajiv just said, that when we think about things on the assets on the balance sheet, we also need to think about intangible assets. A lot of what we think about assets are buildings, roads and all that. These are tangible assets. There are intangible assets as well. So if you think about some of the largest smartphone manufacturing companies, they don't own a factory, they don't own anything. They just have a brand and they have a product and they know the supply chain. So these are, since the 1990s in the US, investments into intangible assets have exceeded investments in tangible assets.
Right.
And I think if we need to break out of the middle income trap, so the countries, we will, I think, most likely get into the middle income level, but to break out of the middle income trap, the few countries that have broken out have actually done so by investing significantly in intangible assets. So do more R&D, so build intellectual property, build brands, so that we are not just left assembling phones for someone, but there are Indian companies whose branded phones are selling outside. We are not just sort of helping large software companies build software, but there are Indian software companies selling outside. And so as we think about the country over the medium term, I think we need to create this culture of building intangible assets for the future as well.
Great. Rajiv and Neelkanth, thank you for sharing your thoughts. I really enjoyed the conversation. I hope you did as well.
Thank you for having us, Sameer.